welcome back to our portfolio series. This is feeling like a very timely video to us. Interest rates have once again fallen to historic lows, and we're going to keep this video short, but we want to talk about duration. We're going to tell you what it can be used for, why it's important, and why it matters to you. If you're investing in a portfolio that contains bonds within it, then duration is going to play a role in how your portfolio performs. Duration is a quick and easy stat you can use to measure how much interest rate sensitivity the bond or bond portfolio has to changes in interest rates. The larger the duration number, the more interest rate sensitive it would be. So we'll keep it short there, but I want to compare two different types of bonds as we talk about this. Duration is different than maturity. So simply knowing the maturity of a bond doesn't tell you enough, and we're going to illustrate that point with our next slide. We've set up an example here so you can understand the difference between duration and maturity. So we have a high yield bond and a treasury. The high yield is in blue. We have coupon payments, and then we have principal repayment and maturity. The treasury bond is in gray, same schedule of coupon payments, and then principal at maturity. The treasury pays a lower coupon than the high yield bond. So when you think about duration being a weighted average of all cash flows, the more you're receiving ahead of maturity, the more it pulls duration shorter relative to that maturity date. To go a step further, if you had a zero coupon bond, which paid everything back at maturity and nothing along the way, in that case, duration and maturity would be equal. Any bond with payments along the way, duration is going to be different and going to be shorter than maturity. Now, I've told you that duration is important for a portfolio. I don't want you to just have to take my word for it. We're going to show you why it matters. So to set this graph up, we are looking at the impact of a 1% increase in interest rates. We have a variety of different types of bonds. We have government bonds listed at the top. We have corporates listed towards the bottom. And there's two bars, a blue and a gray. The gray bar indicates actual price movement. The blue bar is adjusted for the yield that each bond would issue. So if we look at the 30-year treasury, it would lose 19.2% of its value with a 1% increase in interest rates. The 10-year treasury loses 8.7%. And if you notice, as you move shorter in term there's less of a price decrease to the overall bond with the given change in interest rates. Now, if you look at the corporates, there are some notable differences in how they behave. The very last bond on our chart here is the floating rate position, and it loses just 0.1% of its value, but generates enough yield that it actually comes out in the positive. Now, I want to point out here we have some solid sources. They're listed right below this chart. This is using historical data, and there are ways to calculate the impact of interest rate movements on these bonds. However, this is not a guarantee. This is not an indication of exactly how much bonds will move at any given time in the future, because there are all sorts of variables that move bond prices. But if we can isolate interest rate risk, this should help to understand how interest rates and bond prices are related. What we're saying here is that duration is not a good or bad thing inherently. We're shooting this in the context of an environment where interest rates are very low. But if there are shocks to the system and capital flows towards assets that represent quality, that flight to quality can sometimes lead to some increases within the very assets that have quite a bit of duration. So we're saying get to know what your bonds hold, get to know what your portfolio holds, and make sure it's the position that you want to have for the given environment that you find yourself in. So why would I stand here and shoot a video about duration right now? First of all, we think it's going to be important to understand how these positions move in the coming years and how duration plays a role in that. Duration's not the most exciting topic. If you're interested in investing, a lot of times stocks tend to get most of people's attention. Bonds can be kind of pushed to the side. They're the boring asset. But we're just saying, hey, double back, take a good look at what you're owning. This is going to play an important role in the coming years. And I want to re-emphasize here, duration is not inherently good or bad. There are times when you want it. There are times when you might want to try and avoid it. That's going to shift depending on what's happening in the world. A lot of variables there. We're just encouraging you to get to know duration and get to know how it works within your portfolio.